Okay, welcome back to Infinite Investors, the home for all new and non-investors. Today, I'm going to do a video on how to perfectly time the market. Within my comments, I get a lot of questions that surrounding timing the market. Now, we know there's that very famous quote, time in the market is better than timing the market. But when it comes to practicing it in reality, it's very different for different individuals. Some individuals, when they see a dip, want to buy more. Some individuals, when they see a spike, want to sell off. Some individuals get nervous and sell when it falls. Some individuals, get excited and buy more when it rises. Everyone has different approaches to actually timing the market, all with the same, end goal, trying to have the best performance over the long term. So in this video, I'm going to give you three different stories from three different friends. One who times the market poorly, one who times the market perfectly, and one who actually doesn't care and doesn't time the market at all and just invests. And I'm going to basically compare and give my thoughts about the three different approaches at the end of the video. So if you want to know how to perfectly time the market, please like, please comment, please subscribe, help the channel get to 2,500 subscribers, and we can get the world of investing out to more people in a clear, simple, and transparent manner. So I'm taking this article from the Personal Finance Club, which has a lot of neat articles relating to the stock market. So link will be in the description. Go and check it out. How to perfectly time the market. This is the story of three friends, Tiffany, Brittany, and Sarah, who saved and invested in the US stock market over the last 40 years, 1979 to 2019. All three saved $200 or pounds or euros of their income per month for 40 years, for a total of $96,000 each. But after 40 years, they all ended up with different amounts based on their investment strategy. Tiffany, Brittany, and Sarah all knew the value of buying and holding, and they all invested in the same thing, an S&P 500 index fund. Once they bought, they never sold and always reinvested dividends, but they had different strategies about when to jump into the market. Tiffany and Brittany were aware that the stock market could be very volatile, and they wanted to avoid market crashes. It turns out they were right, as there were 4 significant market crashes during the last 40 years, as shown here. Black Monday, 33.4% drop. Kuwait War, 19.7% drop. Dot-com crash, 49% drop. And the financial crisis, 56.5% drop. So I'm not going to go read each section, but I'm just going to summarize. Tiffany Top is effectively the worst performer. What she does is she saves $200 in a savings account for an 8-year period, and she gets 3% interest in that savings account. But what she does is that every time she invests at the absolute peak of the stock market. So each time when the stock market is at its peak, right before it starts to drop, that's when she loads in the money that she's invested over the past 8 years. And she does this every single time there is a stock market, or right before the next stock market drop. Even with that perfectly bad timing, from her $96,000 investment, she still ended with $663,594. So to be clear, when the market was at its absolute peak, right before it dropped, she took the money from her savings account and invested every single time, and that she still returned a $663,594 performance. Brittany Bottom was the complete opposite of Tiffany. So she, like Tiffany, saved all her money into a savings account, and she got 3% interest as well. However, she was able to perfectly time the market. So at all of these bottoms, what Brittany did is that the moment it was at the 33.4%, the 19.7%, the 49%, the 56.5%, before it started to curve upwards again, she put all of her money in. So whereas Tiffany put it all in at the top, she put it all in at the bottom. The same $96,000 for her turned into $956,838. But it's interesting to note that comparing the absolute worst market timing versus the absolute best, the difference is only a 44% gain. Both Brittany and Tiffany could have the vast majority of their growth thanks to buying and holding a low-cost index fund. So they both had the same amount and they both invested, one at the top, one at the bottom, and there's a 44% difference. One still got 663,594, the other got 956,838. Then you've got Sarah Steady, and the difference with Sarah Steady is that she didn't give a damn about the tops or the bottoms. What she did is take a dollar cost averaging approach, and she always put in $200 on a monthly basis. She never saved it into a savings account. Every single month she auto invests $200 into the S&P 500 index fund. The first month, the last month, every single month she did the exact same thing. At the end of her period, she ended with $1,386,429. So she didn't even buy at all of the bottoms. She bought at all of the bottoms and all of the tops, and she still yielded a better return than Brittany, who timed it perfectly, and Tiffany, who obviously timed it poorly. So what you can see here, amount saved and invested. Let's recap. $96,000 each individual invested. They invested in a buy and hold S&P 500 index fund. Tiffany, with the worst timing, ended up at the end of the 40 years having $663,594. Brittany, with the absolute best timing in the world, got $956,838. And Sarah, who didn't care about timing, bought every single time, stayed in the market, $1,386,429. So I know some of you guys are thinking, how did she get better than Brittany, who timed it perfectly? Because she stayed in the market the whole time. Rather than actually get the 3% interest with inflation and all of the other stuff that will erode your capital over the time, she just kept on putting her money into the market in that period, and actually shows being in the market, time in the market, is better than trying to time the market itself. Now, there is the spreadsheet. I went and checked out the spreadsheet, and it basically shows the calculations. I did do my due diligence, and it does make sense as well that this actually works. So I wanted to basically give my thoughts on that a lot of the time we are all thinking about when to time the market. You know what, this stock has dropped too much. Should I buy more? Should I buy less? This stock has risen too much. Should I wait until there's a specific dip? And I'm guilty. I do the exact same thing. I'm no different to any one of you guys in terms of looking at my portfolio and reacting to macroeconomic changes in prices, fluctuations, news, earnings, whatever it might be, trying to see ways that I can actually maximize the performance of my portfolio. But one of the reasons I wanted to share this article, not just for your own benefit but for my own benefit, is that I've always maintained, and I'll put a link in the description of a previous video where I've always maintained that I think the S&P 500 is one of the stocks that, if you were to hold only one stock in your life, or if I was to hold only one stock in my life, the S&P 500 would be that stock. And $200 a month, obviously I don't know all of your personal finance situations, but £200 a month or €200 a month is not the most expensive amount to put away in the long term. And so this article hopefully should be relatable to the majority of people. I know it won't be relatable to everybody, but at least to the majority it should be relatable that, you know what, with £200 invested on a monthly basis into the S&P 500 over a 40-year period, you will become, or hopefully, if the market goes in the same direction it's gone in the last 40 years, you will in the next 40 years become a millionaire guaranteed. And when we talk about things like pensions and SIPs and LISAs and help to buy ISAs and all of those other retirement products that might be around in the market, one thing that I personally feel, rather than going for something like a pension, is just to invest in an S&P 500, ideally within a tax-free account such as your investment ISA or whatever the equivalent is in Europe or USA. I think Roth IRA is the equivalent over there, and making sure that you just continue to invest that 200 and you continue to reinvest those dividends. So this has been a good article for my own personal self, because even with my S&P 500 approach, there were times when I saw it rising and I thought, even though this is my retirement fund, so to speak, I don't even add any money into it, and I've undersubscribed into the S&P 500 over this year. And so for going into 2020, one of the things I'm definitely going to do is to continually invest a certain amount into the S&P 500, come rain or shine, just because I think in the absolute long term it will always be you know, a great performing ETF, a great performing fund that will, you know, give me a comfortable retirement in the future. So I hope you found this video useful. If you did, please like, please comment, please subscribe. Get in the comments about your thoughts and feelings about, you know, timing the market. And you know, my last thoughts are just try and, you know, think about your strategy for next year, and think about, you know, what is the most important things you should be focusing on. Should you be focusing on, you know, the news and the events? And you know, the stock markets have dropped today again because Trump has tweeted, and there's always going to be trade war stuff, etc., etc. But really and truly, if you are genuinely investing for the long term, maybe all of that stuff isn't actually important. You should just continue to invest, and not try to time the market. I'll put the link in the description. Please like, please comment, please subscribe, and I will catch you next time with another investment video. Peace.